What's going on, people? All right, I got another video for you guys, and this one is going to be one of my top videos so far. And I really hope you guys watch this one all the way through. Watch it all the way through, because I'm going to be showing you guys my absolute favorite pair to trade OTE on. This is a video I should have done a long time ago. A lot of you guys have been asking me, what are the best pairs to trade? What are the best pairs to trade for OTE and all that? Usually I like to stick to the USD pairs because they're pretty reliable, but there's this one pair, it's not a USD pair, I'm going to go over, that has been really consistent. Now, it's not the most consistent, but it makes up for it in its ability to have a very high risk to reward, which I'm going to show you guys in a little bit. But for now, please make sure you like the video, subscribe, just do me a favor, just like it right now. It's a nice thing to do. Like, just do a nice thing for me today, because you're probably a very nice person. So just do a nice thing, like the video and subscribe and press the bell so that you can get notified, so that we nice people can keep talking to each other. All right, let's get into the video real quick. Okay, so drum roll, CAD Chef is my favorite pair to trade OTE, and I'm going to show you guys why. Okay, now I'm going to do this best in the form of just doing my traditional analysis, so you guys get like the whole spiel on how to actually trade OTE. But at the end of the day, I want you guys to keep something in mind, why this is my pair. At the end of the day, the most important part is because of the consistency and the risk reward. Okay, so I like to start off in a higher time frame, going to a smaller time frame when I'm doing my initial analysis on a pair. Okay, so you don't have to do this every day if you are trading OTE every day, because you don't have to look at the weekly chart every day. You know where the weekly chart is at generally. Okay, but if you haven't done your initial full analysis, then you should. Now, CAD Chef historically for the past decade has been falling. Chef has been getting stronger against the Canadian dollar. Makes sense. Swiss franc is a strong currency, and a lot of people like to keep their deposits in that country because of their ability to hide taxation and all that. We've seen that CAD Chef has been ranging in this area, right? This is a big support resistance pool right here. I don't know the official name, I just like to call it a support resistance pool. But the major thing here ICT teaches is that when you see that this graph is bouncing off this point here, look, 1 2 3 4 5 6 7 8 9 10 11 12 13 14, right? Whenever it comes to this point, it usually bounces back to where it came from, right? Unless it really breaks through it. So we saw here that CAD Chef came back into this level, consolidated a little bit, what we call distribution, and started to fall back down, just like it has done in the past when it usually comes around this area and bounces off, right? Bounces off. So we had this big move where it bounced off a little bit, right? But it shot down, okay? But now we saw that it was able to stay a little bit, and so that means it's probably going to keep going down for a while, right? Whenever you have a consolidation around this area, usually buyers and sellers get a little confused. They're going back and forth because this area is really expensive, and so buyers are wondering, should I keep buying? Do I think it's going to keep going up? Or sellers are saying, oh, it's too expensive, so it's going to go down. Eventually, they reach a consensus in the market that this is too expensive, and everybody starts to sell off. So it starts to sell off a little bit. That's what this schematic looks like right here, right? When you have this big jump up, and then you have this distribution in an expensive area, right? Expensive in terms that this is a higher price than down here, right? 0.69 is less than 0.73. Okay, now let's get into the weekly chart. We know now that from the weekly we're kind of we're bearish, we're a little bearish, right? On the daily, check it out. You see this low and this high, but this high is lower than this high, right? This low is lower than this low, right? We're probably going to make another lower high pretty soon, but this could also develop into a little double bottom, right? But the time frame that I was looking at before, we were still a little bearish. So let's go down a little bit more. There's going to be two examples I want to show you guys real quick. So if we look at this if we look at this candle, is this August 2nd? No, let's get August 2nd. Yeah. So at the beginning of this daily candle, right? Usually when you see one bearish daily candle, it's followed by more bearish candles, right? When you see one bullish candle, it's usually followed by more bullish candles. So when you see one daily shift in direction, you know that, or there's probably a good chance, right, that it's going to continue to fall at least another day or two, right, before it rises again. And we can see that happening here, right, here. Usually you see this happening when there's there's usually a direction in terms of where it's going, right? You got this high, you got this low, lower high, lower low, you know. And so when you get a direction like that, this concept usually holds. When it doesn't hold is usually when we're just kind of like going in one direction. You can see here that kind of just like consolidating. It's one white after blue, and it's a little confusing. So I usually wait till you get a little bit more direction to do this. So you have this bearish candle, right, and its previous day high, and this bearish candle, right, with its previous day low, right, previous day low. You set those up first, right, and then right, you see the second candle. So basically, let's imagine we're on what day is this? July 30th, right? This is the business day before August 2nd. We're trading, before trading pause for the weekend, right? So July 30th, right? Here we have a bearish candle, like I mentioned before, previous day, previous low. But because it was a bearish candle, we're gonna attack the previous day's low, because like I said, after one bearish candle might follow more bearish candles. Okay, so we get here, and let's go a little bit deeper into the 4 hour, right? This is the previous day high and low right here. You can see it. Let's just see what's going on. This is August 2nd. Anything here that we should look at? No, it looks pretty consistent, right? It's pretty bearish. Let's go to the 1 hour, see if we can find anything. Any areas for smart money, right? There's a little bit of, look at this right here. I would have been a little concerned about that on that day. A little bit of liquidity that should be attacked, but you can see that this candle right here spiked above these highs, right? This is what we call a, like retail highs, right? Or a resistant level highs, right? And above here are buy stops, right? Where if you trigger, when the candle breaks through that high, right, and it triggers your buy stop. So let's say I set a buy stop here. I'm gonna teach you guys this real quick. So I want to go over everything, have a very holistic, point of view for you guys. Some of you guys may not be as advanced and don't know as many smart money concepts. If you're not familiar with these concepts, then you should go watch the rest of this playlist and go to some of the how does smart money work videos. But you can see here, people will put buy stops above this area because usually, this is a resistance level, and when it breaks out of resistance, people expect it has enough momentum to keep going up, right? So people start buying a lot. However, when you trigger these buy stops, right, there's two sides in the market, right? There's a buyer and there's a seller, right? And the institutions always want to be on the opposite side of what the retail people are doing. Retail is people like you and I. Institutions are things like big banks, and big banks have a lot of money, right? And like I mentioned, you need a buyer and you need a seller in every transaction. But institutions, right, have so much money that they don't have enough people on the other side with the same amount of money to do the transaction, right? You can't do transactions with thin air. You need someone to have the same amount of money. Or you can have one big bank and have multiple people with small amount of money that equates to how much money the big banks have, if that makes sense, right? And so the banks need to influence you to be on the other side. So they do this little spike above these highs and make you think, right? Well, this is not let's not say banks, because I actually work at a bank. So let's not say banks. Let's just say algorithms, right? Algorithms for, big institutions, right? They spike up and then they get drawn down by the sell volume that comes from, big algorithms and big institutions. This huge candle cannot be caused, right? This huge candle is not caused by retail clients. Right? It's not caused by you and I. I didn't do that for sure. I don't have enough money to do that. Guess who does though? Institutions. And so they cause this huge shift in only what? This is an hour movement. How many pips is this? Ridiculous amount, right? So this is definitely a smart money move. So once I saw this liquidity got taken out, that's further confirmation that it's probably going to continue to go down because institutions are on the sell side. We know which side we want to be on the market. We want to be with the institutions, right? So that's a further analysis. So I like to check the 1 hour. I like to go, time frame by time frame. I couldn't see this right on the 4 hour or even a daily or weekly. Just go check out the 15-minute real quick. See if there's anything else. Right? Okay. Nothing much. You can see here that we had a little bit of consolidation here, and then we got the same move. This is why I really like this pair, because it's just so predictable. You know, it's just smart money to the T. Look at that. This candle broke out of here, took out these highs, right, and came back and mitigated that candle right here. It mitigated those candles, because when the institutions, you know, push out and collect that liquidity, right, they're pushing this out. How are they getting it to go higher? They have to buy it first to push it up, and then trick you to think that you should keep buying. And when all the buyers come to market, they immediately close out their buy positions and sell it, right? And then they have to break even on those initial positions. So they have to put, it comes back up a little bit, right? When they close it out, then it comes down, right? So this is the traditional pattern of a smart money play, right? You have this right here, right? Got a breakout, and then you have a play, and then you have the restoration right there of the break even. So when you have a little breakout, it needs to come back and touch it. You can see that this wick right here came back and touched this candle that took out this liquidity right here before it fell. So now that we've analyzed a little bit, we can go straight to the 5 minute. We know that we're bearish, we're super bearish, and so we're gonna go ahead and just find an OTE opportunity, right? So I'm actually only gonna do one for the sake of time in this video, and then the next video I'll do the next analysis. So remember, we start at 8:30 a.m. Eastern Standard Time to 11:30 or to 11 a.m. right, Eastern Standard Time. So I put my 2 lines there, and this is our trading window. This is what we call optimal timed entry, right? This is our trading window. So let's say it starts at 8:30 a.m. on August 2nd, that Monday. I was trying to trade, right? This is what would have happened. Okay, so I would have seen, my bearish outlook, and then we had all this liquidity up here. I would have been waiting for that to get taken out, and then wait for the mitigation in order for us to start to really sell off, right? It would have been a perfect setup, right? So when this candle got taken out, and I saw this high right here, I'll be waiting for the pullback, right, for the mitigation. So I'll take it to this next low and wait for it to touch the 62 level, just like it did perfectly to the T, to the literal textbook T, right? And then I have my stop loss. But like I said, don't, in my other video, my last video, I mentioned don't set a stop limit, right? Don't set a sell limit or buy limit. So set any limits, right? Just do all this market order. You should be sitting at your desk watching these trades happen. It's only 2.5 hours a day. It's not a long time, right? Just discipline yourself, wake up at 8:30 and just watch. Don't set any limits, because you got to see what happens. Like I mentioned in the video yesterday, what happened with the dollar was that at 10 a.m. there was a news report released, and it was a perfect setup, but it spiked because of the news report. So you don't want to have limits because of the spikes. You just want to watch it. And if you see the momentum is very nice, right? The candles are slowing down. It's coming to the 0.62 level. You don't think it's going to spike. You enter in your order market. Set your stop loss above the fib retracement. Right? You can look at these levels, so you can copy the levels I have. Right? You draw from top to bottom since it's bearish. Right? Draw from top to bottom. Have it pull back to the 62 level. Your target is -2. That's an easy 1 to 6 trade. There was another one like that this morning, but I'll show you guys that in the next video. For now, hopefully that was enough. I think this was, a perfect example of why Cash App is my favorite currency pair to trade. I really hope you guys feel the same way. And I wish you guys, happy trading. Make sure you guys like and subscribe. Don't forget to do that right now, especially if you like the video, then like the video. All right, guys, peace and love. Happy trading.